Welcome back, students who are taking financial accounting, and in this series of videos we are working on the chapter 4 assigned chapter 4 problems from group B that were assigned in the digital study guide. As always, this here is about understanding an application. So right now, doing the homework problems is an application thing. It's one thing to do a problem and get it wrong, and that's the application part, but it's another thing to do the problem, get it wrong, and not understand the underlying concepts. So if you're not getting the underlying concepts, like for example, how to make a journal entry when you don't know how, that stuff was covered, in previous theory videos for previous chapters. Go out on the student community. There's like other videos, introduction to accounting and bookkeeping that explains things like how to make journal entries. And if you're not just getting the understanding of the concepts, go back and watch the theory videos. And then if you still don't understand something, feel free to, contact an instructor by email or telephone. So we're working on problem 4-44B here. And it says here, let me get my pen. It says the following sales-related transactions occurred during the month of April. Journalize the transactions and omit explanations. Okay, so April 3rd, we sold 3,200 and our cost was 1,400 of merchandise on account. So we're selling on account. Terms are 115, net 45, FOB destination. All right, so are we affecting cash? No, but we're affecting accounts receivable because we're selling it on account. So our accounts receivable increases, so we're going to debit our accounts receivable for 3,200, and then we're going to credit, our revenue for 3,200. Now I'm going to put, I'm just going to write small up here because I know that I'm not going to use an additional slide here and bounce back and forth. But I know that we're going to be paying, these are going to be paid, or they, like for example on April 30th. So I'm going to just put those entries up there so that we can see them. And of course, if we sell something out of inventory, all right, whenever you sell something out of inventory, you also have to make a second entry in order to take something out of account. So it's not just recording the revenue. Okay, you make a sale, yes, you need to make the journal entry to record the revenue, but you also have to take it out of inventory and put it to cost of goods sold. So our inventory account is decreasing, so we're going to credit our inventory. In this case here, the cost was 1,400, and that means debits have to equal credits, so we debit something else, and of course that's going to have to be cost of goods sold for 1,400. Right, so the one thing that just did jump into my mind is, it all depends upon the inventory, obviously. If you're selling, furniture or automobiles where you can, specifically identify a particular item, then yeah, you would make this entry to take it out and put it to, take it out of inventory and put it to cost of goods sold. However, if you're dealing with something like groceries or M&Ms or something like that, you might not make this second half of the entry, right? For the simple reason that at the end of the accounting period, you're going to make an adjusting entry to adjust your inventory based upon what you took as a physical inventory, meaning, you have all of your entries on your books and you have an amount in your inventory account. And yeah, you've made sales. I mean, let's face it, you're not going to record every single, bottle of milk and loaf of bread and candy that was sold every single day. It's wiser, and that's why you see people walk around the stores with scanners. Okay, they're scanning the inventory, and so they get a physical inventory of it, and they say, okay, whatever we have in our general ledger, we have to adjust it to, the actual physical inventory. So then they end up making, this journal entry at the end of the month to adjust the inventory. But like I said, for larger items that you can specifically ID, and it's easy to keep track of, when you make your when you make your entry for to record the revenue, you also make an entry to record the taking it out of inventory. Right, so on for April 4th, paid $85 to ship the goods sold on April 3rd, right? So since that's associated with the inventory, okay, see, we're paying, since that's associated with the sale to somebody else, all right? So if we're paying it, we're going, are we affecting cash? Yes, so we're going to credit our cash because we're decreasing it by $85. Now, since it's a sale, we have to match our revenues with our expenses. So I would not put this shipping and associate it with the inventory, okay? The inventory, we would if we were buying it to put it into inventory because that would be cost of our inventory. But when we make a sale, we also have to associate it with the expense, okay? It's called the matching principle. We have to match our revenues with our expenses. So when we make the sale and we have shipping on it, this becomes an expense. So in this case here, I would call this freight and shipping expense. They're calling it delivery expense in the solution. So that would be for $85. And so my journal entry would be debit to delivery expense and a credit to cash for $85. Okay, 410, we sold 2,300 of merchandise to cash customers. Okay, so on 410, we're selling something, so is our cash increasing? Yes. So we're going to debit our cash for 2,300, and we're going to credit our revenue for 2,300. Relatively simple. Okay, and of course we have to take it out of inventory, so that's basically going to be the same entry that we have there. So I'm going to debit. I'm going to debit my cost of goods sold, and I'm going to credit my inventory, and that's in the amount of 1,025. And so that's that journal entry. Okay, so we're up to there. Okay, we received payment in full from B. Levin for the April 3rd sale. So if we're receiving payment in full, well, what was our accounts receivable? Okay, our accounts receivable was 3,200. So if I had a debit to accounts receivable, that means I have to credit accounts receivable for 3,200. Oops, yeah, for 3,200. However, what are they going to pay? When we sold it on account, the terms were 1% 15. So if this was April 3rd and 15 days later is April 18th, during that time period, they're allowed to take a discount. And today happens to be the 17th. So they're able to take a 1% discount. So I have to calculate the discount. Take 3,200 times 1% is $32. Okay, so I have to debit sales discount for $32, and debits have to equal credits, so the difference between the two is $31.68. So I'm going to end up debiting my cash because that's what I'm going to receive. I'm going to receive $31.68 for cash. Right? Now I could have gone and notice what I did. I took 1% of 3,200, and then I take the 3,200 less the discount of $32, which gives me $31.68. I could have also, just to figure out the cash, I could have taken 3,200 and said, okay, 100% minus 1% less 1% is 99%. So that's, I could take 99% of the 3,200 because that's the amount I'm going to be receiving, all right? It's like that pie chart thing. This is 100%. this is 1%, then this has to be 99%. Okay, and so this is the amount in cash, and this is the amount in discount. Right? So that's the journal entry for that. All right, let's see here. Okay, on 4/22, we sold 4,800 of merchandise on account. Right, terms are 2% 10. So on 4/22, our entry is going to be basically the same as what we have up here. Okay, you know, we're going to have, you know, we're going to end up debiting our accounts receivable for the 4,800, and we'll credit our revenue for 4,800, and we have a debit to our cost of goods sold because we're putting it, you know, taking it out of inventory, and that amount is 2,800, and then we're going to credit our inventory for 2,800. So let me just write in those numbers here. It's 28. Okay, so that's that entry, 4/22. Okay, so then on 4/26, granted, Kelkins a $900 allowance on the April 22nd, which is this one, you know, entry, all right, due to minor defects in goods shipped. So if we're, I'm sorry, 4/22, if we're allowing them a $900 allowance, okay, am I affecting cash? No. Am I affecting accounts receivable? Yes, because we're giving them $900. So if my accounts receivable was a debit for $4,800, that means I'm going to credit my accounts receivable for the $900, okay, because we're reducing the accounts receivable by $900. And debits have to equal credit, so I have to debit something else. And what am I doing? I'm giving them an allowance, so that would be my sales return and allowance account for $900. And so that's the entry for that. And I'm going to write that up here just kind of small for 22, return on allowance 900, and accounts receivable for 900. Okay, so that's 4/26, 4/26, not 4/22. On April 30th, received payment in full for the April 22nd sale. So on 4/30, we're going to receive payment in full, right? So what's our accounts receivable? Well, if I have an accounts receivable and I had a debit of 4,800, and then I credited my accounts receivable for 900, that means I have a balance here of 3,900. So I'm going to, in order to reduce my accounts receivable to zero, I have to credit accounts receivable for 3,900. Now, the question becomes, since it was sold on account and it's 2% 10, right? You know, we're doing the same thing as we did before. You know, here's our timeline. 4/22, 10 days is 5, 30 days April. 4 is April, has 30 days in it, so that means it's going to be 5/2 is our discount period, and they're paying it on 4/30, so it falls within a discount period, so they're able to take a discount. Now, if we're at 3,900 and we take 2%, that's $78. So I'm debiting sales discount for $78, and of course the difference between the two ends up being 38.22. So I'm going to, all I have to pay is a debit to cash for $38.22. And again, I could take 100% less 2% and take 90% of 3,900 in order to get the amount of cash. Or like I just did, take the 3,900, find out my discount of 2%, and then subtract. So the difference between those two numbers right there, okay, is how much my cash is going to be, because my debits have to equal my credits, right? But the underlying theory is obviously that I have a retail price, or in this case here, the 3,900 less the 2%, and that's the remainder that I have to actually pay in full on my accounts receivable. Okay, so that's the journal entry, and that's it for this video, and I will see you in the next one.